Welcome to Reverse Mortgage Radio, hosted by Legend's very own reverse mortgage professor, Bruce Simmons. You have so many options with a reverse mortgage, everyone has a different opinion, and the government keeps changing the rules. You need to hear from the first certified reverse mortgage professional in Colorado to specialize exclusively in reverse mortgages, one of few in the state with the letters CRMP after his name. Bruce has the specific training and education you need to understand what you're buying. Now, here's your host, Bruce Simmons.
Hello, and welcome to another episode of Reverse Mortgage Radio, the show where we cut through the confusion and talk truth about reverse mortgages, what they are, how they work, and how they can change your life for the better. I'm your host, Bruce Simmons, and I've had the honor of helping senior homeowners navigate retirement for over 2 decades through the power of reverse mortgages. If you or a loved one is 62 or older, own your home, and want to explore safe ways to supplement your retirement income, you're in the right place. Please call me directly at 303-467-7821. 303-467-7821 with any questions about reverse mortgages, or visit me online at reversemortgageradio.net. reversemortgageradio.net. You can download my free consumer guide on there. You can also get a free quote on how much you might be able to get from a reverse mortgage. And I don't sell your information. I'll be the only one contacting you and answering whatever questions you have about reverse mortgages. So let's go ahead and get on with the show. In this episode, we're going to talk about the incredible, the flexible home equity conversion mortgage. It's the FHA-insured reverse mortgage program called a HECM, H-E-C-M, Home Equity Conversion Mortgage. And one of the most powerful benefits of this loan program is the flexibility it offers in how you can access your funds from the reverse mortgage. So if you ever wondered, do I have to take all the money at once? Or what if I just want a little bit every month? Today's the show for you, because we're going to talk about all the different options. Let's start off, though, with a quick refresher about what a reverse mortgage is. First of all, a reverse mortgage is a loan program created by an act of Congress in 1987, signed into law by President Reagan in 1988. It's a benefit for senior homeowners who've earned that benefit through age and equity accumulation. You might think of it like the benefits a veteran gets with a VA loan. This is a benefit provided by the federal government for senior homeowners. In a nutshell, the way I like to explain it is that it's a loan specifically for people that are 62 and over that allows you to convert a portion of the value of your home. You can tap into some of that equity without selling your home, giving up title, and also without making mortgage payments. Now, you do have to continue to pay your own homeowner's insurance, property taxes, and maintenance on the home. So you have to maintain the home. You have to also live there as your primary residence and keep your name on title. But as long as you do those 5 things, you never, ever, ever have to make a mortgage payment. The house stays in your name. Remember that. We'll touch on that in a little bit. But it stays in your name, so that's why you have to do these things, because it's still your house. And also, too, just as one quick thing, I had a customer of mine. She's also a listener of the show, and she was asking me, because it's been a couple of years since she'd taken out the loan, and one of the things you have to do every year is sign an occupancy certification saying that you're still living in the home. She called and saying, hey, am I supposed to be getting that soon? And we talked about it. But then she said, why am I being charged interest on my own money? That's a common question that I get from people, because you're tapping into your equity, right? But it's actually a loan from a company, from a mortgage company that's loaning you the money. Just like if you get a regular mortgage on your home, you get a HELOC from the bank, it's a loan against your house. You're borrowing someone else's money, but you're using your home as security for the loan. That's the way the reverse mortgage works. That's kind of how all loans work. I mean, you never get a loan for nothing. Well, Sometimes you do, you can get like a 90-day same as cash or 6 months same as cash, where if you pay it off in 6 months, you're not charged interest. But that stuff's built into the price. Whoever you're buying that mattress or that ring or whatever the case may be, whoever you're buying that from has built the cost of that interest into the price of the product you're paying, okay? You're paying for it one way or another. There's no such thing as a free lunch. But with a reverse mortgage, you're still charged interest on the loan, but you just don't have to make the payment. So it provides you cash flow, because in retirement, we all know cash is king, right? So let's talk about some of the flexible choices that you get with a reverse mortgage. Like I said, actually, let me back up. The way it works is FHA, the Federal Housing Administration, there's a ton of rules on this loan that we as lenders have to follow in order to have that FHA mortgage insurance protection on the loan. And the lender is dictated to by FHA on how much we can loan, and it's based on 3 factors. One is the age of the youngest homeowner, 2 is the value of the home, and 3 is the interest rate. So based on those numbers, FHA dictates to us how much we can loan you. The higher the interest rate is, the less money we can loan as a percentage of the value of the home. The younger somebody is, the less money we can loan as a percentage of the value of the home. Conversely, the older you are and the lower the interest rate, the more money you can get, okay? The key thing with reverse mortgages is we've got all these flexible payment plans. However, you do have to pay off the existing mortgage first. So, for example, if we can qualify you to receive $200,000 from the reverse mortgage, and you owe $175,000 on your existing loan, well, we have to take the first $175,000 of the $200,000 from the new reverse mortgage to pay off your old loan and eliminate that mortgage payment. So remember, you're not eliminating the whole payment if you pay taxes and insurance as part of the payment. Most people pay principal, interest, taxes, and insurance, PITI. And the taxes and insurance portion is still your responsibility. So if your mortgage payment is $1,500 a month and your taxes and insurance are $500 a month, you're not saving $1,500. You're saving $1,000. Which, hey, sign me up if I can save $1,000 a month, right? So that's kind of how it works. But then we pay off that $175,000. That only leaves $25,000 left over that you can tap into. And that kind of can limit your options. I talked to somebody this week who, she has a big mortgage on her house, like $240,000 or something. And we can only loan her about $244,000. So she's going to end up with paying off her mortgage and eliminating that payment, but she's only going to have $4,000 left over. However, she's going to be saving like $1,700 a month in principal and interest. So that's a huge amount. You say, well, why would you do that? You don't get any money back. No, but you're keeping $1,700 a month in your pocket. That's like a $1,700 raise every month. And that's a pretty sweet deal, if you ask me. I'll take that every day of the week. So just remember, when I'm talking about these flexible options, whether it's a lump sum or a line of credit or monthly payment or whatever, you have to pay off the existing mortgage first, okay? So let's touch on the choices that you have with the money left over after you pay off the mortgage. Or if you own your home free and clear, that's the best option because you've got all these things at your fingertips you can tap into. Number one is a lump sum. So you can take the money as a big lump of money, lump of cash. However, there are limitations on that. FHA puts limitations on it, and we'll touch on that in a minute. You can also do a line of credit. That's awesome. It works like a HELOC, only better. Monthly payments, and this is where we pay you every month. We deposit money in your bank every month, and there's a couple different ways you can set that up. But you can also do a combination. That's the most popular. Most people do some kind of combination. But here we are. Now, let's start off with option number one, the lump sum. The lump sum is what most people imagine when they think of reverse mortgage. It's a big one-time payment at closing. Okay. Now, there are limitations that you have to do. Number one, like I said, we have to pay off the existing mortgage. We have to qualify you too. You do have to go through financial assessment, meaning we have to show you can afford to live in your home, pay your taxes and insurance and maintenance on the home and all that stuff. But the key thing is that FHA puts these limitations in there. So if you own your home free and clear, let's just go back to that $200,000. So we can loan you $200,000. You have no mortgage on your home. We can loan you in that the lump sum you can take in the first year, the maximum is 60% of the money that you qualify for. So that's $120,000. Now, we also have to pay closing costs out of that too. So you don't get net $120,000, but you get 60% of the $200,000 you could take in the first 12 months of the loan. The rest of the money is available to you in a line of credit if you choose the adjustable rate program. On a fixed rate program, you get that lump sum and boom, that's it. No more. Sayonara, take your money and run type situation. But with the adjustable rate, you can leave that other $80,000, the other 40% of that $200,000 in the line of credit. And then a year from now, you can take the rest of it out. And that works great for some people. Other people, they want all the money in one lump sum. And there's some other options in that case, like a proprietary loan, if that's a possibility. But that's a key thing. Now you say, well, you just said, what if I owe $175,000? That's more than $120,000. Correctamundo. Good question. So in that situation, you're borrowing more than 60% to pay off your mortgage. And we can do that. If you owe more than 60% of the amount of money available to you, we'll loan you that amount of money to pay off your mortgage. However, we're still going to give you a lump sum if you want it, but we're going to cap that lump sum at 10% of the amount of money available. And we call that the principal limit, the amount of money available. But I'm just going to keep saying that because it's simpler. So you've got $200,000 available. You take $175,000 to pay off your mortgage. That leaves you $25,000. But you can't pull all $25,000 out in one lump sum because FHA says, well, you can only take 10% of the $200,000 in one lump sum in the first year. So that means you could take $20,000 at closing and you'll have $5,000 available to you 12 months after your closing. Hopefully that makes sense. So we're talking about reverse mortgages here. Thank you for tuning in. If you just found us, it's Reverse Mortgage Radio you're listening to. I'm your host, Bruce Simmons. We're talking about the different ways you can receive the money from a reverse mortgage. My number is 303-467-7821, or visit me online at reversemortgageradio.net. Go there, download my free consumer guide. Watch videos, testimonials from other customers, whatever. It's all good stuff on that website. But that's the first way, okay, the lump sum. Number two we're going to talk about is the line of credit. And I have done whole shows on the line of credit. I've done shows comparing the line of credit to the traditional HELOC. And we're going to touch on some of those here, but we're not going to get into as deep as we do when I just focus solely on that line of credit. But the nice thing is you can set up a HECM line of credit, and it works a lot, like I said, like a home equity line you'd get from a bank, but with powerful twists. Number one, the unused portion of the money grows over time. Let's say you have $200,000 available. You take out $100,000 to pay off your mortgage and as a lump sum and all that stuff, and you leave $100,000 in the line of credit. The line of credit gets larger every single month. It grows at the rate of 0.5% greater than the rate you're charged on the money you borrow from a reverse mortgage. So let's say the interest rate you're being charged is 6.5% on a reverse mortgage. That means your line of credit grows at 7%. So in other words, if you left that $100,000 in there, a year from now, you'd have roughly $107,000. I say roughly because it compounds monthly. Okay, so you'll have more than 107, but it'll be in that range. And so that's just extra money that we're making available to you. The key thing to remember about this is that is not interest. It's not free money. You're not earning interest like you would at a bank. You're not earning anything. You don't have to pay taxes on it. We're just increasing the amount of money you can borrow. Any money you take from this reverse mortgage is borrowed funds. Don't forget that. You're borrowing from the equity in your home just like you would if you had a regular equity line. All right. But the nice thing is so many people keep that money in reserve for emergencies. And the nice thing is it can never be closed out as long as you live in the home, you pay your property taxes, pay your homeowners insurance, maintain the home, and keep your name on title. It does not matter what happens to the value of the home. The value of the home could drop to zero, and you could owe $200,000 on the loan and still have $50,000 in the line of credit that's accessible to you. It's always accessible as long as you keep up with those 5 things that I just mentioned. People keep that money for emergencies. They keep it as part of long-term care planning. That's kind of my plan that I plan to do. An estate buffer too. Let's say you, hopefully, knock on wood, this does not happen, but let's say that you get diagnosed with stage 4 cancer. The doctor sends you home. Hey, we can't help you. Then you say, okay, well, let's see. My house, the kids are going to need some money to care for the estate. I'm going to take my money out of the line of credit and have it in the bank for the kids or give it to the kids so they could help settle things out. You know what I mean? Now, granted, they'll owe more on the house, but let's say, for example, you owe more on the house and it's actually worth at that time. So over the years, the interest has accrued on the loan. So your loan balance is now $500,000, but the value dropped on the home and the home's only worth $400,000 now. And you've got $75,000 in the line of credit left over. You can take that $75,000 out, put it in your bank or give it to the kids directly. And it doesn't matter because the nice thing about reverse mortgages is they're 100% non-recourse. What that means is that you can never, ever pass a debt to your estate or your heirs that's beyond the value of the home. The absolute worst case scenario is that there's no equity left in your home. Now, odds of that happening these days is very, very slim. Number one, values are pretty steady. Even right now, where property values aren't going up tremendously, they're still going up, 2 to 4% in most locations around Colorado. So the odds are you're never going to find yourself upside down. However, if you do, you're protected. Just keep that in mind because that's one of the huge benefits of reverse mortgages. Also, too, there are tax benefits to doing this, having that money in a line of credit. And also, if you wanted to pay some money back, because the money you get from the reverse mortgage is not taxable. I call it tax neutral. You're not going to be able to deduct the interest you're charged because you're not paying it in most cases, but you're not going to be charged in taxes on the money you take out. So even that growth on the line of credit, because it's borrowed funds, you don't pay taxes on that like you would if you put a CD in the bank or something like that. That's one of the huge benefits as well, to not having to worry about taxes. However, if you keep this loan for a long time and you draw money out of an IRA for some reason, you could apply it to your loan balance and receive a deduction on your reverse mortgage. So because you pay $20,000 in interest on your reverse mortgage, now you can deduct that money from your taxes. And then you could have access to it too, because you can make payments on this loan. A lot of people don't think of it that way because it's promoted that there's no payment required, and that's true. However, it's more of a payment optional program. When you get the reverse mortgage, you can make payments on this loan, and any dollar you put in, or every dollar you put into the reverse mortgage, gets moved over to the line of credit, and that line of credit will then grow by that amount. So if you deposit $1,000 today, your loan balance will drop by $1,000 and your line of credit will grow by $1,000. And then that growth rate will apply to that $1,000 that you added to the line of credit too. It's really a very, very slick system. And there's even more tax benefits that I don't have time to get into. let's talk about the monthly payments. This is where a lot of people have heard in the past where they say this is where the reverse mortgage is where the bank pays you instead of you paying the bank. Because for years, when this loan first started out, most people took out a monthly payment. They were, single women usually. They wanted $500 or $600 or $800 a month to supplement their income, and that's what they did. We set up that money in a monthly payment, and they just received it every month, guaranteed 100%, no matter what happens to the value of the home, just like with the reverse mortgage. If the value of your home goes down and you owe more on your house than it's worth, and you set up the payments based on a 10-year plan, Tenure, 10-year is what it's called. That's where it's guaranteed to last as long as you live in the home, no matter what happens. So as long as you're living in the home, paying your taxes and insurance, maintaining the home, and keeping your name on title, you're going to get that money every month, even if you're upside down on the house. That's a huge benefit. It's guaranteed. But that's the 10-year payment where you're guaranteed it as long as you live in the home. We calculate that payment. So let's say when we calculate this payment, we figure out it because the risk is higher for the lender because we're guaranteeing it to you forever. So we're not going to give you as much as if you took it out, say, over 7.5 years. For example, let's say we qualify you to receive $1,200 a month, guaranteed as long as you live in your home on the 10-year payment. But you say, well, I really need $2,000. And then I say, okay, well, we could give you $2,000 a month, but it's only going to last for 13 years and 2 months or whatever, however long. We calculate it. And then you can change this plan too down the road. So let's say that you're getting you say, okay, well, I'm just going to go with the $1,200 a month. That's it, or whatever it is. I'm getting $1,200 a month. I'm just going to do that. But then something changes. Inflation, medical issues, you have an extra, you end up inheriting a grandchild that now you're caring for and you need to up your payment. You can make a change on the payment plan. So now you can receive that payment, a higher payment. Granted, it's not going to last forever, but you can still receive it. So that's a beauty of this loan too, is that you can make changes to the program. Okay. Number 3, the other way we're talking about doing it is a combination strategy. So this is where it gets pretty fun. I mean, you're not limited to just one option. Let's say you want to pay off your mortgage and maybe get an extra $10,000 to do some home repairs. And you say, well, I really need some, even without a mortgage payment, we're still running kind of tight, and an extra $500 a month would go a long way to help us feel safe and secure. We can set, and if you have enough money available, we could set that up, and a lot of times still have money left over in a line of credit. It's a very sweet deal, and then you can still make changes to the plan down the road too. If life situation changes, and now suddenly you need a big lump sum, which is more than what you have available in the line of credit, you can reduce your monthly payment or shorten the term, or however you want. Or if you get money, you can put it back into the program too. So there's, again, a lot of different options. But just as a quick example, I did a loan almost a year ago, exactly, with a customer, and she's a listener as well, so I don't want to say her name, but we'll just call her Carrie. And she was a 72-year-old lady, spry, very, very spunky. She did not look her age. She walked miles and miles every day. Fantastic health. She's just an energetic person. Very, very fun to be around. But she had a $550,000 home or thereabouts, and she owed less than $50,000. She is 72 years old. She didn't want to move. She wanted to stay in the home forever. But she had no need to actually take any cash out at that time, but she knew she needed some extra money every month as well. Well, what we did is we paid off her mortgage, and we also set her up with a $550 payment and she did like 15-year term. So, well, 15 years, who knows what's going to happen? But we set her up with this payment for 15 years for $550 a month. And she had a line of credit. Now, I didn't look up the amount of line of credit. I'm thinking it was around $60,000 left over in a line of credit. So she could, she could take that money, and let's say she's still living there 15 years later. She could take that the money that's available in her line of credit and convert it to a monthly payment if she wants to still receive a monthly payment. Or let's say after 8 years, she needs to increase her monthly payment. She could pull money from that line of credit to increase that monthly payment. So what we do is we say, okay, that line of credit that started out at 60 is now 80 years or 80,000. So now we're going to take away 40 of that and put it into a monthly payment to increase her monthly payment, say from $550 to $700 for another 8 years or whatever. So there's a lot of different options that she can do with that. It's just a fantastic program with so many different options. That's why I call it the incredible flexible HECM. It's just a ton of things. Now, real quick, I want to bust a few myths because I still get these things. I'm working on a loan for a purchase. The people are looking for a home right now, and I talked to the realtor this week, and she said, I talked to this commercial broker who's a really good friend of my dad. He's very professional. And I told him we're going to do this reverse mortgage because the dad is the realtor's custom. The one that's moving, okay, is the realtor's dad. And the realtor said she talked to this professional broker, a commercial broker, and she said she was getting a reverse mortgage for her parents. He said, don't do it. No, don't do it. And she said, wait a minute. What's going on here? No, it's good. You don't understand it. And he had all kinds of misconceptions. He thought that he said, don't let the bank take the house. Well, that's one of the biggest misconceptions. They think that either the bank owns the home if you get a reverse mortgage, or the bank's going to take the house when you die. Neither of those happen. The house stays in your name like we talked about. Remember, you have to pay the taxes and insurance and maintain it and live there and all that because it's your house. If it wasn't your house, you wouldn't have to pay the taxes and insurance and maintain it, right? So it's your house. And then when you pass away or you permanently leave the home, that's when the loan comes due. And what happens is your heirs inherit the home. They choose what to do. They can sell it, they can refinance it, they can give it to the lender and walk away if there's no equity in the house. So there's that. That's the big one. And then there's other things people think, well, I can only get a reverse mortgage if I own the home free and clear, or the exact opposite. I can only get a reverse mortgage if I have a mortgage on it and I'm paying it off. Those are common things too. And then the worst one is that it's only for desperate people. And that is so not true. Not true at all. I'm not desperate and I'm going to get a reverse mortgage. I'm looking forward to the day when I can. So please feel free to call me. I really appreciate you listening today. My name is Bruce Simmons. I'm the reverse mortgage manager with American Liberty Mortgage here in Denver. You can reach me directly at 303-467-7821. 303-467-7821. Visit me online too. Like I said before, you can download my free consumer guide, check out all the information on there, the video testimonials, get a free quote, all that stuff. And I don't ask for a social, and I'm not going to be selling your information. Have a great day. I really appreciate it. Until next time, be well and be informed and take care of yourself.
Call Bruce Simmons today. Ask about his free Colorado Consumer Guide, 303-467-7821 or reversemortgageradio.net. Bruce will come to you anywhere across the Front Range to make sure you understand how reverse mortgages work. Regulated by DORA, NMLS number 409914. American Liberty Mortgage is an equal housing lender.